In finance, the devil is in the details. Hello and welcome back to Exploring Finance with Prashant. I am thrilled to have you here as we continue our exciting journey in the world of financial shenanigans. In our previous episode, we shed light on how companies differentiate between long term and short term beneficial costs in financial reporting, emphasizing the tactics they use to manipulate financial statements and inflate the earnings. In this episode, we delve into the world of financial shenanigans and the consequences of not reporting all the expenses when dealing with taxes and financial reports. We discuss the stark difference between the foolishness of not reporting the expenses on your tax return, which leads to higher tax bills, and the strategic use of this tactic by some management to deceive the shareholders into thinking that profits are better than they actually are. Let's get on with the first technique, failing to record an expense at the appropriate amount from a current transaction. In this first technique, we explore various tactics that are used to hide expenses and inflate the income, from delaying vendor invoices to clever collaborations like Syntax Brilliant's massive vendor credits and even managing unresolved disputes. These maneuvers can distort financial reality. We will also delve into the importance of recognizing off balance sheet liabilities. So let's dive into this art of financial deception. Let's try to understand all the things with the help of different examples. The first one is of symbol technologies. A clear example of failing to record end of the period expenses occurred when they paid employee bonuses in the March 2000 quarter but didn't record the $3.5 million obligation for FICA insurance until a later period when the cash was actually paid. FICA stands for Federal Insurance Contributions Act. This improper delay in recording the expense led to a 7.5% overstatement of the company's quarterly net income. Another example is a clever financial maneuver. Imagine telling a supplier you will buy $9 million worth of office products over the next year, but they agree to pay but you agree to pay an inflated price of $10 million. And in return for this large order, you negotiate a $1 million upfront rebate upon signing the deal. What is the catch here? You record this rebate immediately as a reduction in your office expenses, artificially boosting the earnings by $1 million, and which should have been recognized as a reduction in the inflated future office supply cost. Now let's dive into the case of Sunrise Medical dealing with the supplier. The same thing which I just told you in the form of an example was done by Sunrise Medical. Sunrise Medical signed a secret letter. They signed this arrangement, they sealed this arrangement with the help of a secret side letter, and they recorded the rebate as an expense to decrease without disclosing to investors or auditors that the supplier has tied the rebate to a price increase on the future purchases. It's a case of hidden financial tactics at play. Another example is of Syntax Brilliant that is engaged in an elaborate vendor rebate scheme, receiving substantial vendor credit from its primary supplier and significant shareholder, Colon. These credits, falsely recorded as cost reductions, exceeded the company's entire gross profit during its public history, causing a stark disparity between the apparent profitability and severely negative cash flows. And the credits, merely bookkeeping entries without a cash exchange, should have raised red flags for investors like us, underscoring the importance of scrutinizing the financial statements and footnotes for unusual transactions in financial reporting. So, what did we learn from this technique? First, we learned it is very crucial to approach the cash receipt from vendor with skepticism. Usually, the cash receipts are not there from vendors because vendors are our creditors. So, we pay them. It is generally cash outflow. Therefore, if there is any unusual cash inflow from the vendors, it should be viewed as a potential red flag, signaling a possible accounting trick or deception. Second, While some obligations require only footnote disclosure and don't impact the reported earnings, investors should closely examine the commitments and the contingencies in the financial report footnotes and the management discussion and analysis section for valuable insights and risk assessment. Let's move on to technique number 2. This technique showcases how management's discretion in choosing the accounting policies and estimates can be used to conceal the expenses. Companies offering pensions and post-retirement benefits or leasing equipment can alter their accounting assumptions to lower the recorded expenses, enabling them to manipulate the earnings and decrease the reported liabilities. Let's understand these things with the help of examples. First, let's talk about lease accounting. It offers management a realm where they can manipulate estimates to boost the earnings. Take D-Ray and Company, leasing farming equipment, for example. The key expense is equipment depreciation, determined by the asset's initial value and expected end of the lease value, or we can say that is residual value, with the difference evenly spread across the rental period. However, management can reduce the gap between the initial value and the ending value by increasing the portion allocated to the residual value. In 2012, DeRay estimated that the residual value of its rental equipment would amount to 55% of the initial value, leaving 45% to be depreciated, right? However, in the coming each of the subsequent years, this estimate increased. This estimate means that the residual values estimate increased, reaching 63% in 2015. By increasing the estimate, the company would now be depreciating only 37% of the initial value. And because of this subtle change in the estimate of the residual value, DeRay materially lowered its depreciation expense and artificially boosted its gross margin and operating income. Do you know what are self-insurance claims? A company's self-insurance reserves, also known as self-insured retention or self-insured retention funds, are funds that are set aside by the company to cover potential losses and liabilities that are not covered by traditional insurance policies. In self-insurance, the company assumes a portion of the risk for certain type of claims or losses and relies on its own funds to cover these liabilities instead of purchasing insurance coverage for the entire amount. Rent A Center Inc., a major rent to town retail store operator, had an interesting approach to self insurance. In June 2006, they decided to alter the actuarial assumptions that are used to calculate their self insurance accrual. Instead of relying solely on the general industry loss assumptions, they incorporated internally developed assumptions based on their own loss experience. This change, while potentially reasonable, had a one-time impact of boosting the earnings, and it likely accounted for a significant portion of the company's earnings growth over the following 4 quarters. Another area to look at is pensions. Companies offering employee pension must regularly account for incremental plan costs, which are typically grouped with other salary expenses on the income statement. However, we as investors should closely examine pension accounting assumptions in footnotes, as they provide management with discretionary tools to reduce or eliminate these expenses. Occasionally, companies may report negative pension expenses on pension income, which occurs when investment gain from pension plan assets exceed the annual plan costs. This is more common in companies with large legacy plans, pension plans, and few new plan participants. For example, Lucent reported substantial pension income in 2004, accounting for a significant portion of its operating income, which would have been missed without scrutinizing the pension footnote. So, what did we learn from this technique? First, companies offering employee pension can adjust accounting assumptions to reduce the recorded expenses. Scrutinizing the pension related assumptions in the financial reporting footnotes is crucial for investors to grasp the financial health of the company. Second, lease accounting. Management can manipulate the earnings by altering the assumptions about the asset values at the beginning and end of the lease, especially by increasing the portion assigned to the residual value. Third, companies that self insure for various risks can adjust their self insurance reserves through estimates and assumptions, potentially impacting the earnings. Small changes in these assumptions can result in significant income fluctuations. Let's get on to technique number 3. Special charges, also known as non-recurring charges, can provide companies with two advantages. First, they can inflate future period operating income because the cost associated with these charges have already been written off. Secondly, the liability established through the non-recurring charges can serve as a reserve that can be released into earnings in a subsequent period. These reserves, which can take various forms and are recorded as liabilities, represent obligation to other parties, while accrual accounting mandate the creating reserves for incurred but not yet expensed cost like warranties. Companies can potentially misuse these reserves to manipulate their earnings. Let's try to understand the paragraph with the help of example. In 2016, Under Armour, despite impressive annual sales growth, fell short of investor expectation, and to offset this disappointment, in the fourth quarter, management reversed potentially accrued year-end bonuses due to missing targets, resulting in $48 million negative expense and a $0.07 boost in the end bonuses in the reported earnings per share. This accounting adjustment was not prominently disclosed, potentially misleading the investors into attributing the lower SG&A expense to effective cost management rather than one-time adjustment. Another example is of Sunbeam Corporation, where the CEO, Chainsaw AI Dunlop, oversaw a large restructuring plan, recording substantial restructuring charges and creating reserves for the future expenditures. However, Sunbeam was later found to have recorded improper reserves that were later released into income, creating the illusion of successful restructuring. Let me give you a simplified explanation of this tactic. If a company announces a 1,000% layoff with a 10 million severance package but later only lays off 700 employees, it can eliminate the remaining liability, reducing an expense and inflating the income. Companies set up significant reserves and then inflate the profits by closing out unnecessary expense accounts when the time is right. Another earning manipulation technique involve failing to record necessary expenses accruals for expected costs such as warranty claims. These accruals are often estimated at the end of a quarter. By tweaking these estimates, companies can inflate the earnings. Dell's computers case from 2003 to 2007 is an example where the company made adjustments to reserve and accrued liability accounts to meet the financial targets. These activities often occurred right after a quarter's end and involved improper adjustments, including creating and releasing accruals and reserves to enhance the reported results. Companies offering warranties with their products are required to record the expense for expected future warranty cost when the product is sold. Management can exercise discretion in the amount recorded as warranty expense each period, potentially inflating or understating the profits. For instance, Dell had issues with improper accounting for warranty liabilities as highlighted by its audit committee. Improper adjustments to warranty liabilities can distort the reported earnings. That's all in this technique. So what did we learn from technique number 3? First, we should monitor soft liability accounts such as other current liabilities or accrued expenses closely and flag any sharp decline relative to revenue. Second, companies often rely on management assumptions and discretionary estimates when recording the expenses. These can be adjusted to meet earnings target, and we should watch that. Third, companies may use supply agreements and reserves as seen in the Marvel's case to manipulate the earnings by offsetting the overpayments. With that, we come to the end of this episode. Let me summarize this episode. We explored three techniques of expense manipulation. In first, we discussed how companies often employ various tactics to hide expenses and inflate the income. We should be vigilant when they encounter unusual financial transactions such as cash inflows from vendors, which typically involve cash outflows. In second, we saw how accounting assumptions and estimates can be manipulated to influence the reported expenses and earnings. Investors must carefully review the financial statement footnotes and disclosures to identify any red flags related to these assumptions and better assess a company's financial condition. In third and final technique, it underscores the importance of closely monitoring the liabilities, recognizing potential manipulation through special charges and reserves, and being aware of the discretion management has in recording expenses and accruals. As a final takeaway, I want you to remember expenses can be manipulated in various ways, from concealing costs to altering accounting assumptions. As vigilant investors, it's crucial to scrutinize the financial statements, especially footnotes, to uncover potential red flags and assess a company's true financial health. Thanks for listening to this episode. In the next episode, we shall discuss methods used by management to improperly shift revenue to later periods. Until then, keep questioning, keep learning, keep exploring the captivating world of finance. Thank you. Have a nice day.